Let's get in a very special fundamental voice on board as well. Rajat Rajgarhia, MD of Institutional Equities at Motilal Oswal Securities, joins us right now on the show on our 7th anniversary. Rajat, thank you so much for taking the time out on this very special day for ET Now.
Thank you, and congratulations to you and your entire team for this special day.
Yeah, thanks so much. Rajat, what are the thoughts? What's the communication to clients currently right now? I mean, there is a bit of volatility. Stay light until a key global event like Brexit is over, or you're still into that whole mode of buying value whenever you see it?
Well, I think we are clearly into a buying zone right now, and maybe at times when you get these phases like Brexit or some other global concern, which has more of a sentimental impact and less fundamental impact, these provides you pockets of opportunities to load up more wherever you can. Because back home, you have a lot more reasons to start getting back into stocks now, and we think that this phase of consolidation at about 81, 8200 is just enabling people to pick the right stocks before markets start looking up again for the second half of this calendar year.
Rajat, do you think there is a lot of money which is there on the sidelines and that money is waiting for the event? And when I say event, the Brexit outcome?
Well, given that everywhere in the world interest rates are moving to multi-year, multi-decades low, right? The option to invest in equities just keeps on going up. But more importantly, if you look at two things, most of the economies have their interest rates at decade lows or multi-year lows. In India, interest rates are at their closer to their highs. We are just 100 basis point off from the last 6-year high, and the growth in most of the economies is slowing, and the growth in India is picking up. So even if the money is limited in the global markets, for people to make bigger allocation to India, the arguments are just getting more and more loud. And I think that is what is going to create outperformance for India from here on.
Rajat, hi, morning. So what's the investment thesis like? I mean, up until now, we've only seen pockets in the market do well, the likes of a Sugar, NBFC, in bits and starts. Some of the PSU banks have seen heightened activity off late. What is it that you're recommending, and what do you think is going to move up in the market from here?
Well, there are two ways to look at how to play this market. One is companies which are continuously and consistently growing at anything between 20 to 30%. So they will keep on compounding that, and we'll come to some of those names shortly. And then you have cyclical recovery, which moves from category to category across domestic sectors, right? The first camp, where you have companies which are consistently growing, I think they have to remain a very core part of the portfolio. The market caps are becoming big for many of these names. If you look at some of the private banks, today we are looking at companies like banks like Yes and IndusInd, which from a mid cap status few years back have become large caps now. And I think the next 3-year growth rates are not going to be any less than the last 3 years for them. They are growing at 25-30%. You have some of the retail NBFCs, companies like Bajaj Finance, some of the housing finance companies, auto NBFCs, all of which are guiding for very strong growth. So this whole pack remains very, very exciting. Then you have autos, and we have been talking about autos very regularly on your channel. This is one space where opportunities to invest will keep on rising as the domestic economy recovers. The last 2 years belong to commercial vehicles, but I think now we are going to see even tractors and two-wheelers joining this party. Cement is on the cyclical part, where after 5-6 years of almost no growth, you have now seen the March quarter number was a first reasonably positive quarter for cement as a space. L&T March quarter was a one big confidence boosting quarter. So there are many domestic sectors where on one hand many companies are continuing to grow, and on the other hand there are few companies which after periods of very low growth are coming back into a growth phase. one has to structure portfolio largely around here. You saw big run up happening in commodities, so that valuation trade has played out. The two big beneficiaries of export models or the currency depreciation, which is IT and pharma, I think it's time to just lie a bit low there. So focus more on plays which are more domestic centric, and use the other avenues to fund them.
In conversation with Rajat Rajgarhia, Managing Director Institutional Equities with Motilal Oswal Securities, and ET now turns 7 years old or young, depending on what you want to, how you analyze it. But yes, it's a big day for us. It's a special day for us, and in order to mark our 7th year anniversary, the who's who of financial markets and corporate India, they would be joining us today. Rajat, a couple of quarters ago when we interacted with you, you said that Eicher Motors has all the potential to be a great compounder. Now, Eicher Motor has been one big success story. A 2,000 rupee stock has become a 18,000 rupee stock in a matter of just 4 or 5 years. As a house, why do you still believe that Eicher Motor could be in for a long haul?
Well, if you look at the multi-bagging piece, that has already been made in Eicher. From here, this is going to be a stock where the earnings growth and the stock returns are more going to closely track each other. The valuation re-rating has already happened, but for this company, on their both the businesses, which is first Royal Enfield, I think this is one piece where the volume growth will keep on happening as you see the demographics turning more in favor of the product that they have a very, very strong market share on. And second, on the vehicle side, commercial vehicle side, because we are expecting this piece to see sustained cyclical recovery for the next couple of years, that will further help to trigger the earnings growth. So from year on in Eicher, you are largely going to see the stock returns tracking the earnings growth right now. I don't see any scope of valuation re-rating left anymore. But the earnings growth itself will be so strong right now for the next 2 years that at least stock should track a return closer to that.
Okay, Rajat, stay with us. Celebrations at ET now continue, and a face that you see almost every day on the channel analyzing all the stocks and strategies. Sandeep Sabharwal is now just about walking in, and he's going to the Wall of Fame or the congratulatory wall to just sign in and give in his wishes for all of us here at ET now. And then, of course, he will be back with us in the studio. But amazing, right? If you bought a Royal Enfield when ET now launched 7 years back, that asset has only depreciated from the minute you take it out of the showroom. Yeah, you would be a proud owner of a Royal Enfield. But if you did buy the stock 7 years back, wow.
You can buy a Mercedes or a Bentley today. That's
Indeed.
The only difference. And a brand new one at that.
Indeed. Rajat, any stock which one can buy for 7 years and it could turn out like Eicher of 7 years back?
Well, I think there are many stocks which at least should compound at 20-25% from here. And the reason why I'm saying 20-25 is because at least that much earnings predictability on those stocks are there. And in phases, you will see market cycles that when these stocks grow at this pace, there will be periods when valuation re-rating will happen. So you will get a return in some of these names as what you are looking at. But I think for that to happen, one has to remain invested in themes which are going to drive or which are going to be played around the story that India is going to evolve around. Couple of themes, I think this whole private financial space, right? If you look at the whole market share shift, last 20 years we have seen the value migration happening. This is only going to pick up pace in the next 10 years, right? This 75-25 of PSUs versus private is going to keep on tilting in favor of private. Companies like Yes and IndusInd have 25-30% earnings growth ahead, and they are still trading attractive. Yes is at about 2 times book, 11 times earnings, right? Valuations could be anything in this cycle once you see the economic growth picking up. Look at companies in auto space. I keep on talking that this is one space where the weightages in the markets will keep rising, right? And today you have companies still at about the largest cap companies in autos are still at about 70-80,000 crores. I think this cycle will throw some very big market caps out of the auto space. Branded apparels is one piece where you can of course get some multi-baggers in this cycle, because as your per capita GDP just keeps on growing, there becomes an inflection point when a large part of this country's middle class will start moving towards branded apparels, and companies which have been able to build brands, build distribution network will be the ones which will encash a lot on this. And lastly, extending the same theme of branded apparels, many of the consumption plays, right from ACs to home appliances to these branded apparels, many of these models are becoming models to create multi-billion-dollar market caps in this next 5-10 years of economic growth.
Great. Rajat, that is exactly the answer that we were looking for on our 7th anniversary, and I'm sure a lot of people have gotten safe compounding ideas from you and your house. Thank you so much for taking the time out and being with us today and giving us your thoughts, Rajat Rajgarhia. All right, that's the view from Rajat Rajgarhia of Motilal Oswal. Quick opening comment, 20 seconds from Sandeep Sabharwal before we move on to the pre-open session. He joins us on the show as well. Sandeep,